Okay, let's dive right into this explainer and unpack how Dell Technologies is pulling off an absolutely massive transformation completely fueled by the AI boom. For a long time, let's be honest, most of us thought of Dell primarily as the reliable, maybe slightly boring company that built the beige computers sitting on our office desks. But if you look at their Q1 fiscal year 2027 earnings, that legacy image is officially obsolete. We're going to look at the numbers, the strategy, and the massive shift that is turning this traditional hardware vendor into a central pillar of the global AI infrastructure.
To really wrap your head around the sheer scale of this market shift, just take a look at Dell's staggering 52-week stock price change following those blowout Q1 earnings. A surge of over 250% in a single year? For a mature, large-cap technology company, that is incredibly rare. The market has completely reevaluated what Dell is actually worth, lifting it right out of that slow-growth legacy tech category and firmly dropping it into the hyper-growth AI sector.
And it's not just the market saying this. As Vice Chairman and COO Jeff Clarke noted during the earnings call, this isn't just some temporary bump in hardware sales. It is a fundamental rewiring of Dell's core business. You see, they aren't just selling individual components anymore. They're delivering fully integrated solutions that customers can literally drop into production on day one. They're capitalizing on the fact that enterprises don't just want AI chips, they want the entire, complex data center architecture required to actually run those chips securely and efficiently.
So the big question for us is figuring out exactly how a mature PC vendor managed to drive their trailing 12-month net income up to $8.41 billion, completely revaluing their market position to a market cap approaching $259 billion. It requires some absolutely incredible operational discipline to generate that kind of bottom-line profit while entirely pivoting your core product focus. Let's move on to Section 1, the AI infrastructure explosion. The new reality for Dell is pretty stark when you compare these two business segments. For Q1, Dell's Infrastructure Solutions Group, which is where they house all their servers, networking, and storage, hit a massive $29 billion in revenue. That is up an astonishing 181% year over year. It completely dwarfs their traditional Client Solutions Group, the old PC segment, which brought in $14.6 billion. The infrastructure side of the house is now without a doubt the undisputed heavyweight champion of Dell's balance sheet.
And the momentum here is just staggering. In one single quarter, they booked $24.4 billion in AI orders, which translated to $16.1 billion in actual AI server revenue. But the most important number to pay attention to is that record $51.3 billion AI backlog. Management even pointed out that their pipeline is actually multiples of that backlog figure. With over 5,000 enterprise customers across neocloud, sovereign, and traditional enterprise sectors, it really proves that their differentiated, full-stack solutions are winning over a rapidly expanding customer base.
Which brings us to Section 2, Core PC Business Resilience.
Now you might be wondering, what about that legacy PC division? Well, it's actually remarkably resilient. It delivered 17% year-over-year growth to reach that $14.6 billion mark. But what's absolutely vital to understand here is how management is handling this division. They are maintaining strict 8.0% operating margins. During the call, management explicitly talked about their pricing discipline. They held off on premature price cuts just to chase volume, especially in those transactional, consumer, and small business markets. Basically, they're using their tremendous scale to make sure their legacy business remains a highly profitable cash cow.
Okay, let's dive into the statistics in Section 3, Financial Health and Valuation. The real story here is the gap between these two valuation numbers. Now, a trailing price-to-earnings ratio of 31.53 might look a little steep compared to Dell's historical average, but notice the forward PE sitting much lower at 21.46. That lower forward multiple tells us a lot. It means investors fully expect Dell to successfully convert those massive AI orders into reliable, surging earnings growth over the next year. The market is basically pricing in a highly profitable execution of these contracts.
And the thing is, they're executing this transition from a position of immense financial strength. They're sitting on nearly $11.6 billion in cash and cash equivalents. This liquidity is a massive strategic advantage for them. It allows Dell to navigate messy supply chain snags, invest heavily in R&D for next-generation AI architectures, and comfortably manage their debt without breaking a sweat.
Plus,
Management's confidence is super obvious when you look at their recent 20% increase to the quarterly dividend, bringing it to 63 cents per share to reward their long-term shareholders. Add that to their aggressive share repurchase program, and you have a company that isn't just hoarding the cash generated from the AI boom, they're systematically returning it to the investors who believe in their transformation.
Let's move on to the horizon in Section 4, Future Outlook and Constraints. Driven by the ongoing expansion of AI from basically just an advisor into a real operator, what management called agentic AI, Dell significantly raised its full-year guidance to a midpoint of $167 billion in revenue. That represents roughly 47 to 50% year-over-year growth. They expect AI-optimized servers alone to generate roughly $60 billion for the year, which is up about 2.4 times year-over-year. That is just a breathtaking forecast.
But to maintain this incredible momentum, Dell faces a major execution hurdle, one that management openly acknowledged during the Q&A portion of the earnings call. Because, let's face it, you can have all the orders in the world, but if you can't actually build the machines, you can't recognize the revenue. The simple reality right now is that demand is drastically outpacing supply. This makes the procurement of memory and DRAM the primary bottleneck for the entire tech industry. Customers are actively trying to secure supply right now and locking it in over multiple years because they know these parts are going to be heavily constrained. So, Dell's world-class supply chain is being put to the ultimate test to hunt down the necessary components to build out these incredibly complex AI server racks.
So, what does this all mean for you? Well, the ultimate question for investors moving forward is this. Can Dell's world-class supply chain actually source the components needed to turn this historic $51.3 billion backlog into bottom-line reality? We know they can win the contracts, they've proven that. But now, in the face of global memory shortages, can they build the hardware fast enough to satisfy the insatiable enterprise appetite for AI? Keep a very close eye on their fulfillment rates next quarter. That's going to be the true indicator of whether this incredible momentum can sustain itself.